Sandeep Tandon, good morning. Can you hear me?
Kuj, I can hear you very much.
You have been bullish and you have been right. Now that the event risk is behind us, do you think Indian markets, which bottomed out at end of March, will continue to gain more steam? Just analyze the news for us before we get into specifics.
So, Nikunj, prima facie, when we look at news on absolute basis, it looks negative. Okay. But as a student of theory of relativity, I will always say, look at relative. India is emerged as in a better sweet spot relative to China, relative to Vietnam or Bangladesh, where we face competition from the export front or any other country. On a relative basis, we are in a better shape. Dollar index has corrected. So again, emerging market theme can come back. So I think the way we took a conscious call in the beginning of March that trading bottom is round the corner, I still maintain we have seen a sharp 8% sort of move in Nifty is corrected. Maybe once this correction get over in a day or two, I think India has potential to recover further from the current levels in the month of April itself. So we have to keep in mind we are living in a volatile world and we have to optimize any short-term opportunity which comes whenever market is like extremely oversold or extremely overbought. So all those inflection points we have to capture. And again, we have been talking about negative about US market right from January. We said the worry is not India, worry is now US market, where extraordinary complacency was there, and we talked about 15 to 20% correction can happen in the US, particularly on the Nasdaq side. I still maintain that stand that US market has still not bottomed out, and particularly Nasdaq has not bottomed. So anything related to technology basket or the which is sentiment linked with the US market should be avoided.
So, Sandeep, now the tricky part is that tariffs are bad news for US. US
Yeah.
inflation will go higher. If US slows down, it will affect rest of the world. So today we may say that okay, tariffs do not impact India, they impact China more. But the reality is that if the biggest economy in the world slows down, that sooner than later will impact global growth, which in turn will impact Indian earnings.
So I completely agree, Nikun. That's one of the reasons we said that first half will be challenging of 2025 and second half will be better. See, the way I look at is that now everybody believe that this whatever step they're taking is obviously is against the interests of US itself. The inflation can come back, which is a larger thesis also for us. For us, but what we have to understand is that the way Trump has played this game, I think it's a well calculated game. He has created so much noise, he like to shake a lot of people, and then he will come on the table to negotiate. So, like whether you're talking about India settling by September or so. So, I think this one tariff is announced, then I think country specific negotiation will start. And I think with this announcement, there will be acceleration in terms of talks process. So, I expect sector specific tariffs will also come into play. And this is the peak of the tariff which we are seeing for India or maybe for the rest of the world. I think going forward, it has only potential to come down. That's the way I read Trump. He's a smart negotiator. So first he has disturbed everybody. Now he's sat on the table and try to settle it. So which will be the maybe short term it can create disturbance in the market. But if I look at the market from a second half perspective, I think it can come back. And stock specific opportunity, let's say India specific, let's focus on India for time being. I think it's a India-centric opportunity, which we talked about larger infra theme or hospitals or hotels, or even talk about the PSU basket. I think the India-specific thing, pharma has been our top sector pick for a while now. I think these are the opportunities which I like to capitalize rather getting too much worried about the global demands, which has obviously has its impact, but there is opportunity also. So I will play the opportunity game rather than getting too much bogged down on the global environment.
Sandeep, something that you track very closely. You think the trick is going to be in the dollar index? The way that's going to move in the months following now, that's going to dictate perhaps which way the global money is going to turn?
So answer is yes and no both. Okay. But what we have to like, if I have to talk about from a very longer term perspective, let's say talk about 3 years, 5 years perspective, then trajectory for dollar index is clearly down. I think dollar index either has already peaked out or has potential to peak out in 2025 itself. But if I have to look at from a very near term perspective, despite that DXY has corrected yesterday, I still believe DXY and global yields, what we have to watch very closely. It has potential to spike from the current level because when nobody expect that, and that's the time reversal happens. So I'm not being getting very complacent about DXY, but yes, I agree. The largest structure has slightly weak, which is a good thing for emerging markets. See, what we have to look at in till the month of January, the extraordinary money flow was going to the US market. If I look at analyze the cross-border data, then definitely it's a very large cross-border flow was there in the US market. I think now that has reversed. And India will be beneficiary of that reversal process, provided even our currency, which has also partially appreciated. So I think emerging market as a basket will do better. Look at Europe has done better than the US. So I think we have to don't have to look at an isolation market. I think we have to look at the relative opportunities. So European market looks better. Even I'm not that negative on China. Maybe today it has corrected, but entire emerging market is a beneficiary. If I have a patient investor for, let's say, 6-8 months perspective, I'm not talking about very far away. If I have to a 6-8 months perspective, also, I think India is a buying opportunity from the current levels.
Okay. Sandeep, so can I say that, okay, I'll tell you what, let me rephrase this question. I'll take the clock back and say that in the month of March, the following factors were at play. Dollar was strengthening, it has weakened. FIs were selling, they've stopped selling. Earnings, economy was slowing down, contraction for India has stopped. And tariff concerns were occupying center stage, which has been addressed. So can I say that all the headwinds in the market have now become tailwinds, and it is time to be reasonably, it's time to now turn reasonably bullish for rest of the year, and market trajectory is not going to be lower, it's going to be higher?
If you want to look at this way, answer is yes. We can say with good amount of confidence that we have seen selling exhaustion on the FI side. This was the biggest negative news which people were anticipating. Finally, that 2nd April date is also over. This is also behind. Now, this is the worst case scenario. The tariff has been announced. The only thing is that for India or any other country, I think negotiation will start. So that Mandavali will start in true sense. And has a now going forward, if I ask me, it has potential to and can come down the rate. This is the peak rate we have seen. However, you might see some sector specific rates which has still not come out in the public forum. Let's say pharma is one aspect, or semiconductor, or some of the other spaces, or aluminum, copper. There might be sector specific thing, and with a minimum expectation of 10%. But I think now that will all depend on the country to country how. And I think India has already taken the lead, so it's a good step, a right step, I will say. So maybe by September, with a lot of people are expecting that it should settle down. I am even optimistic that even settle down much earlier than the September. So maybe worst is behind us. Selective buying opportunity is there, and domestic centric economy stocks one should be. I will not use the word aggressive buyer, but I will be buyer in these things.
Right. So Sandeep, while nothing really changes in one's core portfolio, and I completely get it that it's not timing the market, but time in the market, which has always been beneficiary in the long run. But for more tactical investors, what should their approach be? Because you've had a very steep fall on the Nifty alone, almost about 14 to 15% from the top, and we've recovered halfway as well. There is a lot of sectoral churn at play, and now there's this new googly of how tariffs are going to play out. Yes, there are some sectors like pharma which have been eluded. But as a tactical investor, what should one be doing right now? Looking at this event, and now that it's behind us, you know how bad it could get, you know the ceiling. Should I be doubling up on my SIPs?
So this business is all about risk. And I always say assessing the risk, you have to be ahead of the curve. Okay. Like we were very cautious from last year itself, and finally it peaked out in January. Something it's like everybody is waiting for more clarity to emerge. Okay, let this event play out. Let me see you. If everybody waits for more clarity, then you will not get the opportunity. In any crisis, the opportunity is the best. And that's the way I said in the beginning of March also. So from a behavior perspective, people have given up completely. Like India was buy on dips, that became sell on price. Okay. And if you really analyze the entire position also, there was a classic capitulative move happening in multiple stocks and sectors. So I think the way I will read it, I will take this opportunity or this crisis as a buying opportunity or maybe switching opportunity. Some of the stocks which have not performed, or you think they are more vulnerable, particularly which are more global linked stocks, then I will be very cautious on some of these names. In fact, metals could be one area where a lot of complacency is getting built now. Metals is done well, but if global demand goes for a toss, okay, or this uncertainty gets built from a trade war perspective, then there's an issue out there. So is the case with IT also. One more important aspect we have to understand how do China will react. Okay, if you look at currency has depreciated now 7.3 as of today or 7.31. What is very important, if China take a very hard stand on US and really start the tariff war, then the risk of Chinese stock getting dumped in Asia and Europe will be on higher side. So that is one area where we will watch very carefully. Instead of looking at the US now, I think I will be looking at the perceived risk coming from China, both in terms of policy announcement as well as the action what they will take. So I think China is something which we have to watch more from how they will counter and how they will relate to this development. So that is going to be very important.
Sandeep, where does the entire matrix for small and mid-cap stocks they fit in now? They were bloated, they've corrected. What is happening there? And first, so what is happening there in terms of a theme? And then B, if you could also tell us that with specific small and mid-cap schemes of Quant, have you got inflows or outflows now?
So, see, I have been saying for a while that we are constructive on large and mega large, and along with that, we said small caps looks better than the mid. Okay, because mid cap has its own challenge with only 150 stock basket, and that was a space which was grossly expensive. If you look at 40, 50 to 200 multiples, those stocks were putting all the HNI, family office, FIs, local guys, retail, everybody participated in that basket. So that basket is more vulnerable where the comfort factor is large, mega large, and the small cap. In fact, even the small cap looks far better than the mid caps to me. That's the real. We have increased our exposure to the small cap. As far flow is concerned, we have not seen any major outflow. Rather, we have seen inflow in the small cap basket, but the intensity of inflow, what we have seen in the past, that has come up significantly, but inflow are still positive for a small cap as of now.
What should the sectoral bias right now and for the next 6 months going to be? Pharma obviously is seeming like the obvious trade, and IT a complete avoid. Other than that, if I'm looking at sectoral churn in my portfolio, what should my bias be and what should my avoids be? Both near term as well as for the next 6 months to 1 year.
So if I look at from a near-term perspective, I think, and from a one-year perspective also, I think large infra plays the one thesis which we look at from it. They are largely domestic. Even a lot of people have dumped PSU and they are again become untouchable for most of the money manager. I think that's the area one opportunity. We have increased our exposure to by 6 to 8% in last 2 months or so in the PSU basket. So that's another opportunity which is coming. Then I like hospitality, both hotels and the hospital stocks in general. Hospitality as a space looks good to me. Then if I have to look at, then I will be very selective buying opportunities there. Then it was a very unique play you can play. But anything which is extraordinary hyped, okay, in last 2, 3 years, where we have seen some of these names were trading a absurd multiple, they are most admired territory stocks. Those are clearly avoidable in the current context because there's a mindset is there, oh, these are the best performer now, they have corrected 30, 40%. Let me look for a buying opportunity. I think that will be the biggest trap. Where we have to look at the under ownership, the erstwhile admired territory stocks are now trading in the neglected zone. So those are the names which I would like to optimize. These are predominantly large companies, good management companies, fairly liquid names. And liquidity is very important in the current context. When I say in the risk of environment, safety is the first priority, liquidity is second, and the returns are the third. Okay, so liquidity is also very important, and every aspect, any decision we take, we do look at the liquidity aspect because for us in this market, the impact cost will play a very important role in filtering the stocks.
Okay. So, Sandeep, just to wrap it up with one final point, which is what is in the price right now from an earnings standpoint? Are markets factoring in a 10 to 12% earnings? Are markets factoring in a 12 to 15% earnings? How much of the earning upside or revival is in the price?
So Nikunj, to be very candid with you, as you understand, we don't get into this forward-looking earnings thing, because these are all are assumption-based, and anything which is assumption-based, you get up into a situation where you have positive or negative surprises. What the only thing from a behavior perspective or from the perception analytics perspective we can say, market will be at least 1 or 2 quarters ahead in terms of reversing of the earnings cycle. So if you believe that worst is behind, I still believe that certain sectors, I have not the word sector also, certain stocks have already bottomed out from earning perspective, let's say in March quarter, and some more names will bottomed out by July. So if somebody has to believe these cycles have bottomed out, then I should be a buyer in some of these names. So I think a stock specific call one can take on individual basis. But I will say the earning cycles has for few names has already bottomed out, and many names it should bottom out by July quarter or so. So one should look for a buying opportunity in these names rather than getting too much hyper and paranoid about the global situation. When it was required last year, then people were very complacent. Everybody was aggressive buyer. And now prices are broken, so a lot of people chase prices. And since as a house, we look at more on the inflection points rather than momentum. And our inflection point data is already endorsing there is an upside, is the probability of you making more money by going long rather than by exiting the market.
Such a great punchline. The probability. See, we always look at probability. There's nothing called possibility. Possibility क्या होगा किसी को नहीं पता. Probability. Probability according to him is
Probability of the possibility.
yes.
Yeah.
So probability of the possibility of making money in the market is higher if you stay invested rather than stay on cash. Bottom line.
That's correct. That's correct.
All right. Thank you. Thank you very much for joining us and have a great day.
Thanks for context.
Markets, what do
If you like this video, then like, share and subscribe to ET Now.